Today I would like to analyze Microsoft, one of the leading technology companies in the world. Here we can see the revenue breakdown. The most revenue comes from the cloud business Azure, then the Office business with close to 40 billion, and then the Windows business, Xbox and LinkedIn. So it's an interesting companies with many products. We can see we are down close to 3% in the 1-year charts. So it looks interesting. We're going to take a look at the financials to find out if this company is undervalued right now. The first thing we can recognize is a huge market cap of 2,923 billion US dollar. So it's a huge company. It's the second biggest company in the world by the market cap. We also have a dividend yield of 0.84%, which is not very huge, but we can see the dividend is growing many years in a row already. So the first thing we're looking for is revenue growth in the last 5 years, because we want to invest in a growing business and not a declining business. So we can see here in 2020, Microsoft had a revenue of 143 billion US dollar. This was a 13% increase. Then again, 2021, 17% increase. Then 2022, 17% increase. Then 2023, close to 7%. And then 2024, close to 15%. So overall, this is an amazing growth. It's over 10% and we really like to see that. So it's a check here. The next thing we're looking for is free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to invest in the business, to do stock buybacks, and also to pay back the debt. So we can see here in 2020, the free cash flow was around 45 billion US dollar. This was an 18% increase. Then 2021, we had the 24% increase. Then 16% increase 2022. Then we had a decline in 2023, around 9%. And then we had a strong increase again in 2024, so around 24%. So overall, this is looking great. It's a check here as well. What we also can see, the operating cash flow is increasing higher than the free cash flow. So the reason for that is that we also investing a lot of money in the business. We have the capital expenditures increasing many years in a row now, and now it's at the high in 2024, around 44 billion. So this is also interesting to know. I think this company investing huge in the future. The next thing we're looking for is free cash flow yield over 4%. So this can also tell us about the valuation. If it's under 4%, it can indicate that the company is overvalued. So what we're going to do now, we're going to take the free cash flow in 2024. So this is around 74 billion. Then we're going to divide it with the current market cap of 2,923. And then we're going to get the free cash flow yield. So the number we get is around 2.5%. So I think that's a low number actually, especially it's a huge company already. And I think when you have a huge company, the growth in the future can be limited. So it's not a check here. And I think it can indicate that the company is overvalued right now. Now we would like to see the debt to free cash flow ratio under 5. This means that the company can pay back the debt with the free cash flow in under 5 years. So it's a very important number, because if a company has too much debt, it can risk to go bankrupt, and we don't like to see that. So we can see here's the long-term debt around 39 billion. Then we can also see the short-term debt. It's close to 7 billion, I would say. So we're going to take this number, and then we're going to divide it with the free cash flow that we had, 74. So the number looks already great. I will calculate it quickly. So the number we get is 0.6. So this means the company can pay back the debt in a little bit over half of a year. So this is a great number. Is a check here. We can also see how much money this company has in the bank. We can see here close to 71 billion. So this is a great number as well. They have a huge amount of money in the bank that they can use to invest in the business, to do stock buybacks, etc. So this is a great number, a great balance sheet, I would say. The next thing we're looking for is enterprise value to free cash flow ratio under 25. So this can also indicate if the company is undervalued. The lower the number, the higher the indication for an undervaluation. So what we're going to do now is we're going to get the enterprise value. So this is the current market cap plus the debt minus the cash. And then we're going to divide this with the free cash flow. So this gives us a ratio that we are looking for. So the enterprise value is around 2,898 billion. Then we're going to divide it with the free cash flow of 74, and the number we get is around 39. So this is a very high number, I would say. It indicates again that this company is probably overvalued right now. So it's not a check here. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. So what we can see here, they did a lot of buybacks many years in a row. It's still under 1%, so it's not a very high number, but they buy back their own shares. So it's a check here for me. I would like to give my conclusion about this company. So let's start with the positive. So I believe they have a strong business. They have a lot of popular products. They have the gaming business, the software business, and also the cloud business. They have the revenue growth in the last 5 years in a good rate. They have the free cash flow growth as well. They have a good balance sheet, low amount of debt, and a good amount of cash on hand. But what I think is negative to me is the free cash flow yield is at 2.5%, which can indicate the overvaluation. Especially, it's already a huge company, which can mean that in the future it can be more difficult to grow the free cash flow. And the EV to free cash flow ratio around 39 also indicates the overvaluation to me.